Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. And as usual, we want to thank everyone for joining us this week. We know the market has been a roller coaster. The last 2 months have been aggravating, to say the least. But so what we really want to focus on this week is to really understand where we are in the current market correction. And when we're really speaking about the market correction, we're not speaking about the headline indice, because what's really happening is we're getting rolling corrections underneath the surface of the market. Our sectors that we focus on were first to get hit. This week appears to show signs that has largely ended, and now that market correction is moving on to other areas of the market. So we're going to go through all of that this week. So let's go ahead and quickly get started here. And, I think the bottom line message from this week's update is what happens next. And we talked about that rolling market correction. Now, energy, material, and financial stocks were the first group of stocks to get hit on this so-called growth scare as it relates to the COVID Delta variant and its impact on implied future GDP growth. We're going to go through why there's a lot of misnomers there, a lot of it's fear, a lot of it's noise. But secondly, what we're going to do is look at payrolls. Now, there's a few things that are going to be happening over the coming weeks and months as it relates to benefits expiring. So we want to understand what are the impact on payrolls, what's the impact on growth, and then, of course, how does that impact the bond market and asset allocation and the stocks that we own. Lastly, we will actually go through some charts as it relates to the Delta variant. And I think this will dispel a lot of the rumors out there that we see in the media. Media sells fear. We want to stay focused on facts and data, because that's ultimately what's going to help us make money, not necessarily over the next week or two, but over the next month, 2 months, 3 months. Now, in terms of some of that noise, right, what we did here was sort of gather from our friends at Strategas here, just a group of headlines that have been sort of pervasive in the media, right? And we can see a lot of it is related to plunging bond yields. If we look at the Delta variant, investors worried about how the economy could go into a tailspin over the Delta variant. So all this stuff is fear-based headlines that sell eyeballs, right? Which sell ads. It's good for business if you're a media company. So what we really want to do is how do we sort the noise from substance? And then we want to really allow the data to guide our long-term path. That's really the key ingredient to successful long-term investing. And of course, the way we do things is we want to understand, first of all, where are we from a macroeconomic perspective? What does it mean for interest rates? And what do interest rates mean for asset allocation, right? So as of now, what we generally see is when we look at trends, so we have momentum and trend. Momentum is really sort of stock price action over a 3 to 4, 5-week time period, right? That's really where you get stocks that are in positive trend, but perhaps overbought, which is what happened with energy, financials, and materials, but in otherwise positive long-term trends. Then, of course, we want to understand, are most stocks participating in the rally, right? So when we think of most sectors, are they in positive or negative trend? Right now, what we see is most stocks, broadly speaking, from a longer-term perspective, continue to participate in the rally. Momentum-wise, short-term, we're seeing those rolling market corrections we'll get to in a minute. Those economically sensitive areas of the market, are they outperforming? The last month or so, we've seen those stocks underperform. Our portfolio is geared toward a better economy, a reopening of the economy. And so when those stocks underperform, we underperform. But we're going to go through a lot of data today that suggests the reopening is not just healthy, but accelerating. And so we ask ourselves the basic question of reflation versus deflation. If we're getting a reflating and accelerating growth picture, what does it mean for the 10-year yield? Our models show the 10-year yield goes up, not down, and therefore that's good for GDP. And if it's good for GDP, we want to be in those highly economically sensitive sectors. Does that mean, again, that we can have a month or two where we underperform? Of course not. But we are looking at the broader long-term seismic shifts that are taking place in the market over the next year, 2 years, and 3 years. You know, it's important to remember, for the better part of the last 5 years, we were massively overweight technology. So I think it should say something when we, of any group out there, start to reduce and eliminate our technology position. Now, in terms of strong trend, weak momentum, what we have seen here with the S&P 500 more recently is that the percentage of stocks above that 200-day moving average, which is generally one of those key barometers we use to measure positive versus negative long-term trend, has remained in around 87%. That's a very, very healthy number. In other words, the market's in a positive long-term trend. But shorter term, the percentage of stocks above that 50-day moving average has largely faded from about 90% and above down to all the way to 47%. If you own individual stocks, you have probably felt pain over the last 2 or 3 months. If you own an index fund or you owned a closet index fund, a lot of mutual funds are closet index funds, you probably really haven't felt that pain because those mutual funds and those index funds are largely concentrated in the largest companies, which are holding up the index right now. Now, more recently, if we look at the chart here on the right, the Russell 2000, what we saw was a positive inflection point on Tuesday. After a deeply oversold condition with small cap stocks, what we saw was the advancing stocks as a percentage of the total index on Tuesday and Wednesday was very, very positive. In other words, almost 100% of the stocks in the index rallied on that specific day. That is a positive momentum inflection point. So Russell 2000 led the market down here over the last month or two because it's economically sensitive, and that disproportionately hurt our portfolio, even though we're largely large cap. We're more economically sensitive. So good to see that right off support here, positive momentum as we push higher. Now, we talked about that shadow correction, ladies and gentlemen. The percentage of stocks that have peaked each month is actually quite mind-boggling. So we look at here in May, 24.5% of the Russell 1000 stocks actually had their highest price point in May and have been going down ever since. An additional 20% peaked in June, and an additional 20% peaked in July. So in other words, close to 65% of the market has had peak stock prices versus where we are today, even though the index itself is only 1% off the highs. And how can that be? Well, that can be because the S&P 500 is market cap weighted. The 7 biggest stocks make up 27% of the index. Technology as a sector makes up 40% of the index. So if you're worried about concentration risk, if you're worried about single stock risk, believe it or not, the index, the S&P 500, is something you want to pay attention to and its overall makeup. The Russell 1000, so if we look at each sector from its highs, staples down 9% off its highs. The overall index down 11% off its highs. So again, the S&P 500 is not reflecting a lot of the bleeding that has been taking place in the real stock market. We look at the materials sector off 14.9% off its highs. So we've seen a lot of individual stocks and sectors really pull back here, and it's actually fairly healthy. I know that's hard to hear that, but it's fairly healthy because the market was overbought. A lot of individual stocks were overbought, especially in those economically sensitive areas. So we're getting a deep pullback within positive long-term trend. Now, we talked about that rolling correction. Energy, materials, and financials were some of the first sectors to get hit. And what we see here is the percentage of stocks that are hitting 3-month lows hit 55% for the energy sector. So generally speaking, we look throughout history, a good trading barometer to use is when the percentage of stocks hit 3-month lows above 50%. That's usually a good time you can start nibbling away in stocks within that sector. So we hit 55% within energy, but notice technology only at 16%. So we actually think what's happening here is energy, materials, financials. Most of the damage has already been done, and now we're starting to experience a recovery. You'll notice in the strategies, Tuesday and Wednesday, we were up close to 6.5% over 2 days. Obviously, a big positive inflection point. We're down about 1% today, obviously after that big move, but that's usually reflective of a deep oversold condition. With technology, only about 16%. So we think that that is where the rolling correction may roll to next. So something to be cognizant of there. So longer term, we've talked about for the last couple of months, what are those seismic shifts taking place in the market, right? We always hear about, what the index did in the past, right? In technology, we can see the chart of the long-term technology chart, obviously parabolic upward and to the right. And this fed our returns. This is why we've been one of the top performing strategies over the last 5 years. Why? Because we were close to 55% weighted in technology. We recently rotated out of technology. Our technology weight's gone from about 55% all the way down to 5%. And we've reweighted that into energy, financials, and material stocks, some industrials and consumer stocks as well. What we can see here is just looking at the chart, which looks more attractive as we go forward? Do we want to buy at these prices up here, or do we want to buy at these prices down here, knowing that there are value inflection points coming for those cheaper sectors? So that's really, we're trying to skate to where the puck is going. Again, not over the next week or 2 weeks, but over the next year, 2 years, 3 years, making that broad seismic shift to what's going to drive returns in the 2020s. And we can see that here. So this is the top 10 stocks by market cap at the end of each decade. The only thing that's consistent is the level of inconsistency. So in the 80s, IBM, AT&T, Exxon, Standard Oil, etc. Those were the biggest stocks at the beginning of the 80s. But look what happened by the end of by 1990, it was the top 10 stocks were all pretty much from Japan. Guess what happened? That was the peak in the Japanese market. To this day, the Nikkei has not reached a record high. So we want to be very cognizant of that. 2000, the dot-com bubble. Then we had the commodity cycle in 2010, PetroChina, BHP, ICBC, Petrobras, China Construction Bank. And then, of course, now Microsoft, Amazon, Apple, Google, Facebook, etc. Very tech heavy, even in China, Alibaba, Tencent. Technology dominating the top 10. When we look at the valuations, if we look at the valuations here, the price of sales is now past the prior dot-com bubble high. So record valuations into bubble territory, record ownership amongst all investor classes, and of course, dominating the top 10 as it relates to company sizes as a sector. And we look at the prior history of forward returns when that happens, it's not good. So all these are pieces in a puzzle that paint to a changing long-term picture as it relates to how we want to allocate assets over the next year, 2 years, and 3 years. Does that mean in the transition of that, we can have a period of underperformance? Yes, and we have had that. But what we're really trying to do is set up clients for capturing all that outperformance if you've been with a client with us for a long time, but 2, setting you up for more long-term success over the next year, 2 years, 3 years, and beyond. Other thing to note in terms of the economy. So the benefits are expiring. So if we look across the country, the number of unemployment benefits as it relates to pandemic benefits will all expire by September. We continue to see those unemployment claims fall. So what does that mean for how we want to position the portfolio through to the end of the year? Well, let's take a look. So all those benefits are expiring. So those people who are otherwise receiving those benefits are going to be looking for work. So we want to make sure that if they are looking for work and they're no longer receiving income, that they can actually get a job, right? Are there the job openings there to fill that demand? And we can see here is that the job openings are at a record high. So as those benefits expire, those people are going to be looking for income. Fortunately, this chart is not downward and to the right, it's upward and to the right. And we know from those wage inflation numbers that employers are desperate for laborers and employees. So in other words, more people off the benefits payroll, more people making more money as wages grow, that should generally be good for the economy. And we're seeing it in the retail sales number. One of the things that's been worrying people is, are these real numbers, 53.4%? Obviously not, because we're coming over those tough year-over-year comparisons. But when we control those numbers for the 2-year moving average, what we see here is, yes, we had this big blip as things reopened, but we're now re-guiding higher. at historically high rates. So that is good for the economy. And as more and more people return to the workforce, the sustainability of that spending should continue to increase. So let's go back to our playbook. Benefits expire equals more jobs filled because we have record job openings. That means more income notionally as a nation, which equals generally historically higher spending. Higher spending equals higher growth. Higher growth generally inflects to higher long-term interest rates, which are good for cyclical stocks. And so when we think of why are we positioned in the stocks that we are, this is why. We use logic. We look at the world in the future, not in the past, and we try to position clients for what the world will look like in 3 months from now, not a month ago. And then real quick here on COVID, we know it's on top of people's minds, but the COVID Delta variant first started spiking in vaccinated nations in Israel. And we can see here in Israel, we've started to see those case counts come down. Same with the UK. So as the unvaccinated portion of the population has largely been hit, now it's getting into and running into that wall of the vaccinated crowd. And we're starting to see the momentum of new cases slide in these two countries in particular. Every morning I watch this, Israel, UK, what are those infection rates doing? And seeing if it is leveling off at that implied ceiling once you reach the vaccinated community. In the US, we've had some popping cases, but again, we're not seeing anything reflected in a rising death rate. And I think that's important because when we think of the economy going forward as it relates to COVID's impact on it, remember that the reopened stocks bottomed in November. Case counts didn't bottom until February. And what we're seeing here is, yes, case counts are going up, but when a vaccinated person is getting infected, we're not really seeing serious symptoms as a result. Yes, you might have the odd case or there, but both sides, whether you are in the vaccinated crowd or the unvaccinated crowd, both sides agree on one thing: they don't want to shut down the economy. And so that's why we're seeing activity, whether it's miles driven, whether it's open table reservations, whether it's jobless claim, all that stuff is pointing to an acceleration of overall economic activity. So overall, we're seeing a largely muted impact from the Delta variant as it relates to the economy. And we're seeing rising employment numbers, which is good for economic output. So that means, again, this rolling bear market appears largely complete in the areas that we're focused on, possibly starting in other areas such as technology where we don't really have exposure. Delta variant, muted impact. And of course, we want to stay focused on those unloved areas of the market that are economically sensitive. Again, if anyone has any questions, please reach out to your advisor. Reach out to us at 888-543-3776, and we'll be absolutely glad to walk you through the portfolio or any worries or concerns that you may have. Thank you again for all your business and your time, and have a wonderful weekend. Thank you.